friends, in this session I will discuss about the balance of payment, its meaning and its principles on which its credits and debits are to be entered. Here I will explain all the concepts by taking examples from the US economy. Let us now begin with balance of payments. According to Bo Soderstrom, the balance of payment is merely a way of listing receipts and payments in international transactions for a country. It is an annual statement which shows all the transactions of residents of a nation with the residents of all the other nations. It helps in the formulation of monetary, fiscal and trade policies. Clarification about balance of payment definitions. Balance of payment categorizes all merchandise trade into a few major categories. It gives a summary statement. It records international transactions, which means exchange of goods and services or assets between the countries. For these transactions, payments are required, but it also records those transactions for which no payments are required, such as transfers and gifts. Another important characteristic of balance of payment is it records transactions of only residents of a nation. Diplomats, military personnel, tourists and workers who temporarily migrate are residents of a nation in which they hold citizenship. Let us now focus on principles of balance of payment accounting. We will begin with credits and debits. International transactions are classified as credits and debits. Credit transactions are those transactions for which receipts of payments are received from foreigners. Debit transactions are those transactions which involve payments to foreigners. Credit transactions are entered with positive sign and debit transactions are entered with a negative sign. Transactions which are on the credit side are exports of goods and services, unilateral transfers that are gifts received from foreigners, and capital inflows because they involve the receipt payments from foreigners. Transactions which are on the debit side are the import of goods and services, unilateral transfers made to foreigners, and capital outflows because they involve payments to foreigners. Let us throw some light on forms of financial inflows and outflows. An increase of foreign assets in the nation or a reduction in the nation's assets abroad are the two forms of capital inflows. When a foreigner purchases a US asset, there is an increase in foreign assets in the US because there are receipts of payment from foreigners and hence it is a capital inflow. In the same way, when US resident sells a foreign asset, there is a reduction in US assets abroad. This involves a payment from foreigners and hence it too involves a capital inflow to the US. On the other hand, financial outflow involves increase in the nation's assets abroad or a reduction in foreign assets in the nation because both of them involve payment to foreigners. We will now have a look at double entry bookkeeping. The balance of payment account of a country is constructed on the principle of double entry bookkeeping. Each transaction is entered on the credit and debit side of the balance sheet. This means that each international transaction is recorded twice, once as a credit and once as a debit of an equal amount, because in general every transaction has two sides. Let us understand this with the help of various examples. Taking first example, suppose that a US firm exports goods of $500 to be paid for in 4 months. So US first enters this on the credit side because these exports will lead to the receipt of a payment from foreigners of $500. Now this payment is again entered as a financial debt because US has to wait for 4 months to get the payments. They acquired a claim on the foreign importer. The entire transaction is entered as follows in the US balance of payment. Let us now take second example. Suppose that a US resident visits London and spends $200 on hotels, meals and so on. The US resident is purchasing travel services from foreigners requiring a payment. Thus, it is a debit for US for $200. It is a credit also because it shows an increase in foreign claims on the US. The entire transaction is entered as follows in US balance of payment. Now let us take the third example. Suppose that US government gives $100 to the government of a developing nation as a part of US aid program. This is a unilateral transfer of $100 from US to foreigners. This payment is itself the US bank balance given to the government of the developing nation. It shows an increase in foreign claims on or foreign assets in the US and is recorded as a financial inflow in the US balance of payment. The entire transaction is thus Now, let us look at another example. Suppose that a US resident purchases a foreign stock of $400 billion. This purchase of the foreign stock increases US assets abroad. It will be recorded in the debit side because there is financial outflow from the US. This will also be entered in the credit side as it is a financial inflow for the US because of the increase in foreign bank balances in the US. Therefore, is an increase in foreign assets in the US. This will be entered in balance of payment. Taking fifth example, suppose that a foreign investor purchases $300 billion of US Treasury bills and pays by drawing down his bank balance in the US by an equal amount. The purchase of the US Treasury bills increases foreign assets in the US. This is a financial inflow to the US and hence is recorded as a credit in the US balance of payment. And the drawing down of US bank balances by the foreigners is a reduction in foreign assets in the US. This is financial outflow from the US and the entire transaction is recorded as Now, if we suppose that all the above examples as international transactions of the US of a year, then the US balance of payment would be total credits are equal to total debits because of double entry bookkeeping. Now we will begin with the international transaction of the US. The table 1 shows the summary of the international transaction of the US for the year 2011. Table 2 shows the summary of the exports and imports of US in the year 2011. tables shows the US exports of $2,848 billion of goods and services in 2011. It shows the goods exported of $1,497 billion, service exports of $606 billion, included travel and transportation services given to foreigners, fees and royalties received from foreigners. $745 billion also earned by US as interest and dividends on their foreign investment. The table also shows the imported goods and services for $3,181 billion in 2011. Goods imports a total of minus $2,236 billion. The $427 billion imports of services included the travel and transportation services purchased by US residents. $578 billion paid as interest and dividends on foreign investment in the US. Unilateral transfers to foreigners made by US of minus $133 billion during 2011. This include net US government economic and military grants to foreign nations of minus $47 billion. Net US government pensions and other transfers to foreign nations minus $9 billion, and net private remittances and other transfers minus $77 billion. The official reserve assets of the US include the gold holding of US monetary authorities, SDRs, the US reserve position in the IMF, and the official foreign currency holding of US monetary authorities. If we want to know the total credits and debits of US, we sum the total credits of positive $2,848 billion of US exports of goods and services and income, positive $1,001 billion net increase in foreign owned assets in the US, and positive $39 billion of net inflow of financial derivatives. Hence, the overall credit is positive $3,888 billion for the US international transaction during year 2011, and the overall debits are a sum of negative $3,181 billion of the US import of goods and services and income negative $133 billion. For the net unilateral transfers minus $1 billion net capital account balance and minus $484 billion net increase in the US owned assets abroad, the overall debt total of minus $3,798 billion. As we can see here that total credits positive $3,888 billion exceeds overall debits total of minus $3,798 billion by positive $90 billion. That is, shows that there is negative entry called statistical discrepancy of minus $89 billion with a negative $1 billion of rounding errors. This entry is required to make the total credits equal to the total debits because it is the requirement of the double entry bookkeeping. Now, let us look at accounting balances and balance of payments. As we know that horizontally, balance of payment is divided into three major categories, namely current account, capital account and financial account. First, we will discuss about the current account. In Table 1, the first accounting memorandum is the balance on goods trade, which shows that in 2011, US exported $1,497 billion and imported $2,236 billion of goods, and the net debit balance on goods trade of minus $739 billion. On the other hand, if we look at the services, US had a net credit balance on services of $179 billion. The third component of current account is investment income. If we look at the investment side, US had a net surplus balance of positive $227 billion on investment income. Thus, US had a net debit balance on goods, services and income of minus $332 billion. Adding the net debit balance of minus $133 billion of unilateral transfers to the net debit balance of minus $332 billion on goods, services and income, the total current account net debit balance is minus $465 billion. If there is a surplus current account balance, it stimulates the domestic production and income, while when there is a deficit in current account, it dampens domestic production and income. Now, the second part of balance of payment is the capital account. Table 1 shows the net debit balance of negative $1 billion on capital account transaction for US for year 2011. The deficits in the current and the capital account is financed by an equal net inflow of capital from abroad. The third part of the balance of payment is the financial account. It shows the change in US owned assets abroad and foreign owned assets in the US. Table 1 shows that in 2011, US owned assets abroad have increased by negative $484 billion, excluding financial derivatives, while foreign owned assets in the US, excluding financial derivatives, increased by positive $1,001 billion. This gives a net credit balance of positive $517 billion. When we add the net credit balance of positive $39 billion of financial derivatives and the net capital account debit balance of negative $1 billion, gives the net credit financial account balance of positive $555 billion. When we add the statistical discrepancy of negative $89 billion, it gives the net credit balance of positive $466 billion on financial account and statistical discrepancy for US in year 2011. This is how the US covered its current account deficits with an equal net financial account surplus. Thus, a balance of payment deficit is given either by the net debit balance on all non-official or autonomous transactions, or by the equal credit balance on official reserves or accommodating transactions. We will now conclude today's session. In this topic, we have learnt about the meaning of balance of payment, how it is accounted, what are the principles on which credits and debits are to be entered in the balance of payment with the help of US economy in the year 2011. Thank you.